Hi, my name is Darren Joseph from HTJ Tax. We're the team that seeks to demystify this sometimes confusing world of international tax and the privilege of having a deep conversation with Mark. Mark, can you please introduce yourself?
I'm Mark Morris. I'm based in Switzerland. I've been here for about 26 years. I've specialized in automatic exchange of information, which originally was the EU Commission's EU Savings Tax Directive. And that went on until about 2014, and they scrapped that and they adopted the OECD's FATCA made into CRS.
So can you share with us what it is you do professionally?
Primarily, I provide custodial services for trusts to hold underlying entities or partnerships or unincorporated funds. So what I do is I provide the administration services for the custodial. I don't do the actual custody. And later on, I'll explain what administration services for custodial is. And I'm an expert in CRS and CARF, and I certainly know the intricate differences between CARF and CRS. We'll get into that in a later question, okay? I've published over 600 articles on LinkedIn, and I'm still writing about 10 a week. And I don't see other people covering 99% of the topics on CRS that I cover.
Okay, thank you.
So Singapore's IRAS, which is the Inland Revenue Authority of Singapore, it deleted its controversial guidance to permit a CRS to report nil for settlors of irrevocable trust, which we discussed in our last conversation. So why do you think they made such a U-turn?
You know, the most popular articles I write on LinkedIn is to do with this issue. Okay. I actually get thousands of readers, okay? And I'm sure they're all from Singapore, okay?
Yeah.
So some very good lawyers, top-notch Magic Circle type law firms have commented on me. And they said the OECD put pressure on them. Now, I was aware of the OECD putting pressure on them in 2017 already. It just took 7 years. And so they relented like Hong Kong relented on ORSOs, which is a type of a pension, and they said pensions are not reportable. And I know the OECD actually went there because they were silly. They had brokers trolling China saying, use ORSOs, it's not reportable. And it was on their websites. So, but here, it was the OECD saying, no, it might be null in your eyes because the settlor is not a beneficiary, and so his value is null. But the purpose of CRS is not to say how much money can you spend. It's how much money did you hide offshore or not declare offshore, and then put it in a trust for the benefit of other people. It's obvious the OECD wanted to know how much money did you hide. It doesn't matter that you can't access it anymore. They pushed it. So the lawyers told me a few things. They said what the OECD did was they forced them to take out the you can report no. But they've left in from the implementation handbook, which is the worst area to leave things up to because you can ignore the implementation handbook if it clashes with the CRS and so. It basically says you can report different values if you work out or if you calculate what his value is. So the question is, can we calculate that his value is 0? And no, the implementation says you can calculate other things such as the acquisition value or the current value. It doesn't say you can calculate 0. So by them taking out the null, to me, it's report the value because that's the purpose of CRS.
Okay.